And welcome back to WealthWise. I'm your host, Jordan Kimmel, and I'm bringing on a new friend, someone I came across, did some research, and I wanted to know more about him. It's Gary Antonacci. And Gary, thanks so much for joining us.
My pleasure, Jordan.
All right, so let me just share. I have your book right here. It's a fabulous book. I'm halfway through it already. I read the conclusions. I read you're a witty guy. Um, Before you have a tremendous, obviously academic background. Your management style has won awards. Give us 2 minutes on your background, and I want to jump right into what dual momentum investing is all about. And I probably have more questions than the audience, so I'm really happy to have you.
All right. I started in the investment business in 1974 with Smith Barney and Merrill Lynch on the sell side. And then I actually wanted to learn what to do, which a lot of people in the brokerage industry are lacking in that area. So I got an MBA degree at Harvard and managed money part-time, stock options, and didn't have to go and get a job. I just continued to manage money for my classmates, their families, even one of my professors. Um, and then when the option market became less efficient, I gravitated to manage futures and had some hedge funds back in the 80s. I worked with people like Paul Tudor Jones, Louis Bacon, Monroe Trout, and I handled the portfolio optimization side of things, figuring out how to allocate capital to these excellent traders. We did very well for the next decade, and my business was taken over by a brokerage firm. And then I had to figure out what to do when I grew up. So I did a few fun things and then always kept an eye out for unusual opportunities. And I stumbled across the momentum research that had been done academically. This was about 15 years ago. I read all the papers and I had some knowledge of that already, having worked with uh, trend following through managed futures and
Mhm.
very familiar with relative strength. So I went in and did my own research and wrote a couple of papers and got some awards and then wrote my book. And came up with the concept of dual momentum, where we first identify if something is trending. And there's a systematic way of doing that. You just look at rate of change over a given period of time. And the idea being is, with momentum is that it's persistence in performance. So if something has been going up over a proven length of back history, there's a tendency for it to keep going up. So that's
Yeah,
the
so
first
hold
part.
on, hold on. Let me jump in because this is so, I mean, it's really to me the cornerstone question of investing. And what I've done, Gary, is I've used value, growth, and momentum,
Mhm.
all different proven factors. But the people that I've grown up with, if you will, they have this thing about the reversion to the mean, and everything has to revert to the mean. And so they want to take things that did really well and they want to short them. They want to do things that did poorly and they want to go long. And I tell them, no, no. I believe in magnets, superior companies, superior. So you're out in California. If the Lakers played the high school team 99 times in a row and beat them 99 times in a row, does that mean it's time to bet on the high school team?
That's a good point. But actually, there is some value to mean reversion, but it's a different time frame. That's how stock specialists made a living, is that prices tend to overreact on a short-term basis. So on a basis of several days or somewhat less than a week, you can go against overextensions of the price trend and do well. Also, mean reversion can work on a 3 or 5 year basis. That's the really the basis of value investing. When you see things
Right.
that have been knocked down considerably, there's a tendency for them to bounce back. But again, you have to have the right time frame. Now, for
But
momentum, momentum
yeah.
is used, that's been researched very carefully, and they find the best time frame for that is somewhere between 3 and 12 months as your look back period.
Okay,
It
so
can
that's a
work.
really, I mean, you're answering my question, but I have to kind of digest that a little bit. The So I was going to go back to the simple question of daily or weekly charts. And so sometimes if you're just a technician, you could keep adjusting the time frame until you find the chart that has the right stochastics for you. But the
Yes.
thing is that my guess is your work is more on weekly charts. Am I correct?
Well, it's important to be systematic, not just to go with one thing and then another when, it doesn't work anymore. That's
Right,
a big danger. There's a big problem with overfitting and, trying to just fit past data. Anyone can do that.
right,
But
right,
the trick is to do extensive back testing so that you understand what the characteristics are of a particular market. So I use prices. I use charts to tell, what's been going on, but my back testing has been done with price history, and I use as much price history as I can get. Uh, there's been a study on rate of change using a 12-month look back that they've taken that all the way back to the beginning of every major market. That's a 1600 in stocks, a 1200 in bonds, and they find that it beats buy and hold, not just in terms of return, but it substantially reduces your downside exposure. So that's the kind of research you want to base what you do on. I recently did some research with a colleague in Europe where we looked at channel breakouts, which is something that's been around a
okay,
long time.
sure.
Donchin and Keltner popularized those in the 50s, 60s, and we applied that to um, the French database of industry groups, 84 different industries, and we took it back 100 years, and we showed that beats buy and hold also. And then we also applied it to ETFs that have come out along the same
Right.
line since then. So,
So to me again, super interesting conversation in that I have my own website says, 30 years of art and science, because I do believe that investing has a little bit of art to it. If it was all math, the accountants would be the richest people in the world, and we know they're not, right? And so there's an expression, as you know, Gary, there's never been a back test that's made daylight that didn't work, because when the back test doesn't work, no one shows it. But I think what you bring into effect here is someone who really, really thoroughly researched and then came out of the lab into reality, right? So there's differences between an unemotional market and then what happens in the real world. So maybe you could just share a little bit. Was there any differences or any tweaks you were made along the way from the lab when in managing money?
well, the biggest mistake is not following the models, because that's the biggest benefit for some people with models is just it gives them a disciplined framework so they don't allow their emotions to get in the way and cause them to make bad decisions. Now, what you say is true that there's never been a back test that you've seen that doesn't work uh, because nobody shows the bad ones. But there are ways to make sure that the odds are in your favor. And that's when you do have something, and this is what they do academically, when they have something that looks like it works, they'll want to replicate it in other markets, in other time frames, and you want to
Hmm.
make sure that there's some rationale behind it, that it makes logical sense. So if you get all of that supporting it, then you can go ahead and have some confidence in it. But you still have to be leery because markets change over time. So
Right. Well, so let me just share, what's fantastic here is just, the amount of research, Magnet itself is highly quantitative. Again, it blends value growth and momentum. And your comment about sticking with a model, with your history and your knowledge base, I'm sure you know all the people, most of the people I know, but Joel Greenblatt comes to mind.
mhm.
And Joel said, "Hey, listen, you could have a great model that doesn't work for years." And he shows the model. He put it in a book, three factors, three simple factors. He said you won't be able to follow it because the first month, the first quarter, the first period of time where you're kind of not seeing the performance, you'll say, this is junk and it doesn't work and I'm going to move on to something else. So the belief in your model that stepped in not only research but time is so important. And most people that I work with, they're just too short term. And if something doesn't work for a week or a month or a day or an hour, they're on to the next thing, right?
That's very true. I find that all the time. I get people who come in and will license my model signals, and they think it's going to work, outperform the benchmarks always. And every model, no matter how good it is, will have periods of benchmark underperformance. So people who don't have a lot of understanding and confidence in the approach, they just move on to something else to their own detriment. So the other thing that's important is to have diversification. You know, Ray Dalio says that that's the holy grail of investing is to have good return streams that are relatively low correlated. So that's what we try to do. We diversify across different markets, across different time frames, and across different ways of applying trend and relative strength. So that we have diversity working for us in a lot of different areas. And that smooths our volatility. And
Yeah.
if something isn't working for a while, then hopefully the slack will be picked up somewhere else.
Right. So let me bring up another point because I think your sense of humor in your book is wonderful. I'm going to give a quote in a few minutes, but the point is that in my book too, I said for most people, Gary, for most people, a low cost index fund is just fine, and dollar cost averaging into low cost index funds is going to be, a lot of people. One of the things I talk about, and I don't golf because I never really picked it up, but they say like nobody can break 100, nobody can break 90, nobody can break 80. But we know that in every generation, all you have to do is watch TV on Sundays and Saturdays. There's dozens and dozens that shoot in the 60s. And it's like money managers. Most can't outperform. You're really better off in an index fund, but it's proven over time with strategies and with an edge. There are people who do beat the market consistently. And when I grew up in this business, I wanted to be the greatest stock picker in the world. That was my goal, highest return. And you know what happened, Gary? Everyone got interested in average. And they wanted ETFs and they wanted, just average. And the idea of somebody willing to spend their time and career looking for the edge and creating an edge, I never would have predicted that average won, when I got in the business. I may not have gotten in the business at that time.
I agree with you, Jordan. Most people would be better off in an index fund than with most of the money management or mutual funds out there. Uh, the problem is that you have horrendous drawdowns from time to time,
Exactly.
and that spooks people into doing what's not right, which is to bail at the wrong time. So what I try to do is put in some
Mhm.
safeguards that will get us out of the market before that happens. And even if we have to give up a little bit of the upside, it's worth it to most people. And if you do it right, you shouldn't even have to give up any upside.
Right. So there's two conclusions that you come to in the end, um, which is something that, just really hit me to the bone because I say to people, I only want to handle your equity money. You can diversify you want, buy your bonds elsewhere. I used to be a bond salesman. I got turned off the bonds. You came
Mhm.
up with the statement that's saying using the dual momentum, which is super important here. Because when something starts to underperform, you're not saying stocks for the long term, just stay in for the long term. When something starts to roll over and something starts to underperform, you're quick to say, hey, wait a second. I'm not going to sit through a 40% drawdown. You take action, right?
That's correct. That's what we do. And getting back to your point about uh, the markets and people, um, I got accepted into the University of Chicago PhD program and I turned them down. I didn't want to go because at that time they were heavily into efficient markets. And I had worked with hedge funds and I knew that there were people doing well and it wasn't just through luck. The markets are fairly efficient. They're hard to beat. Most people would do better in an index fund,
Right.
but there are people and there are approaches that have beat the market, and that I think will continue to do so.
And it's just they're hard to find. And you know what? So I'd say again, my old sales talk to people when I was managing their money was saying, "Hey, let me use my golf score. Let me shoot a 70. We'll put 2 points on it. You get 72. That's not so bad, right? Better than
Right.
110, which most people would do." But there's one other point here, and Gary. So there are people, and again, we both agree that most people are better off in an index fund. Those people tend not to watch our show. They tend not to get our newsletter. The people that watch the show, the people that get the newsletter are people that are intent on actually trying to not only have a higher return, but be more intellectually involved and understand what they're investing in and why they're investing. That's what this show is all about. And I've said the stock market itself is a dangerous girlfriend. It's mean, it's rude, it's nasty. So I have to go here. I have to, go to your book that says the stock market's like a woman. Observe her, respond to her, and respect her. But then you say it's not that easy to do. Just ask my ex-wife, which I love in the book, man. You're a funny guy. And so, what I want to share with our audience, Gary, is that you've supplied an article, contribution to this newsletter that's coming out. Right now, we come out with it once a month. I'm sure, Louis Navalier, someone you cross paths with, and we mentioned, from Sabrian, David Brown's group is involved with us. We have really who's who. And, I was lucky enough, I just want to share quickly. I'm going to throw out a name, Dr. Owen Carroll. Any chance?
No, I
Okay,
don't
so
think so.
so Dr. Owen Carroll was the founder of the Stony Brook Business School,
Right.
where I went to school, and he became my director of research for 10 years. And we did this one by one factor analysis. Does it improve? Does it reduce volatility? And we built Magnet together almost 30 years ago. And I have just tremendous respect for fundamentals married with technicals. And that's what I call magnet. And my objective for this week is to finish dual momentum investing. I think not only is it well written with a really fun sense of humor, you can't read it without learning a lot. And that's really what this whole program was built about, Gary. It's fun managing money, it's fun having high returns. The goal of what we're doing with WealthWise and Pro Investor Insights is really to kind of educate and say you don't have to use Magnet, you don't have to use Gary's model, you don't have to use Navalier's model, but the more models you understand, the better investor that you could become. And brand new relationship. I'm really glad to meet you, Gary. I hope you visit us frequently and become a regular contributor to the newsletter and the show. And I think it's delightful to meet you. And I want to say one other thing. So when we visited AQR and we went to see Aaron Brown, I'm sure you know Aaron, right?
Yes. Right.
So we went to visit him. I showed up in a suit and tie, and he was wearing a purple shirt. He
Right.
said the other side of the building is where people wear suit and ties. This is
Mhm.
how we dress over here. So I am purposely dressed in a little bit more colorful shirt than I usually do,
Right.
knowing you're really about substance and not about anything else. So appreciate your time, Barry. What I'd like you to do is share where people can read your blog, your own website, and we'll obviously include that in our newsletter. But for all the watchers of WealthWise, share your contact, where they could find you, where they could learn more about you.
Right. Thank you, Jordan. You can see my website and blog at optimalmomentum.com. There are links there to all kinds of things. And then I'm very good about responding to emails if people have questions. I'm always happy to try to answer them.
Fantastic. Well, Dual Momentum Investing is the book. I know you're writing another one, but we'll be talking to you, I'm sure, plenty more times till the next one comes out. One more time, thanks for your time today. It's Gary Antonacci, and I'm working on and just absolutely delighted to have you. Thanks for your time.
Thank you very much, Jordan. Been a
All
pleasure.
right, we do have to wrap up. It's Jordan Kimmel wrapping up another great episode of WealthWise, and we'll see you soon. One more time, thanks to Gary. We'll go from there.